Welcome to the Capital Stack Show, Real Estate Syndications and Funds.
Welcome back to the Capital Stack Show, Real Estate Syndications and Funds with Shams Merchant. Shams is a commercial real estate private equity attorney who represents syndicators, sponsors, and real estate funds nationwide, helping structure deals, raise capital, and stay compliant with securities laws. I'm Leanne Lyon, and today we are talking about what investors actually look for before they commit capital to a deal. Shams, it's great to see you again.
So great to be back, Leanne. Thank you so much.
Yeah, I'm super excited about this topic, honestly. I know this is everybody's jam, but it's yours, it's mine, so let's go.
Yeah, me too.
So, Shams, before getting into specifics, what are investors really evaluating when they're deciding whether to move forward with a deal?
Sure, great question. So, unlike investing in a deal or in a project when you don't have investors in play, when you're talking about investing and using a syndication or investment fund, there's some other things you have to consider. And the primary thing is that um, you're also managing other people's money. So, your returns, right, whatever you're projecting to make from this deal, has to fit into that mold of private equity and what investors in the private equity industry are looking for as far as returns in a real estate deal. So you can't just be thinking about a real estate deal from the returns that you're making. If it was just your own money, you have to think of now an additional layer, which is what are these returns actually uh, attractive to investors. So that's actually what becomes a big key consideration in when you're doing a syndication or an investment fund versus just investing your own money into into a project.
So, how much of that decision comes down to the deal itself versus the person or team that's behind it?
Yeah, I mean that's the that's the $1,000,000 question, right? It depends on each person's situation. If you're a new syndicator or this is your first fund, you don't have this huge portfolio of deals, you don't have this established or vertically integrated management company, then you don't have the buying power in the market. You don't have the leverage of being able to put a team onto a new project and manage it, right? Like some of the larger groups in the country that I represent have an integrated property management company, right? They could go buy an apartment complex next week for $50 million and be able to take it over and start managing it day one with a great team in place and already scaled with their processes and their systems so they can start making money from that project instantly. If you're a much smaller operator, you don't have the luxury of doing that. So sometimes your what you should focus on more so is then the actual returns and the metrics of the deal itself because you don't have that built out team, right? So you can't collect these massive fees and things like that that some of the bigger players in the industry can collect. They can buy a deal with lower returns, but because you're buying a big deal and already have property management in place, they're able to make money in different ways versus if as a solo operator or as a smaller company you're buying a project, you're going to be more focused on the actual appreciation and the returns that you can get from the deal itself versus fees or anything like that.
What types of investors do you typically see in real estate syndications, and how do their expectations differ?
Sure. So you're going to find a lot of different investors in the real estate private equity space. You have investors that are what we call retail investors. Those are just, high net worth individuals. A lot of high net worth individuals love to invest in real estate because the returns are asymmetrical compared to investing in the public market, like buying stocks or bonds or things like that. So those are one type of investor. Then you're gonna find larger players in the space like family offices. which essentially are, it's private money that is managed or controlled by, a group of people. Um, and so you're going to find those players, and then you're going to find institutional capital, pension funds, endowment funds that are, investing in projects and looking for, again, more delta than they would get by investing in the public market. So, very lots of different types of investors that are in real estate syndications and real estate private equity, and it just depends on your business model, who you're going to be, um, uh, attracting and going after. So if you're a smaller operator, if you're newer to the space, if you're still getting your feet wet, you're still doing your first couple of deals, you're typically raising capital from friends and family and other retail investors, high net worth individuals who qualify as accredited investors under the SEC regulations. However, if you are a large established sponsor with billions of dollars of assets under management, you can potentially scale up to getting larger check sizes from family offices, from pension funds, endowment funds, from sovereign wealth funds, and even large fund to fund operators. So it really depends on what playing field you're in.
I was taking notes. That's a lot. That's awesome. What separates sponsors who consistently raise capital from those who really struggle to get those deals funded?
Oh, I love this question so much because I get it all the time. Um, So the sponsors that consistently raise capital are the ones that have built out a very strong system on how to do that. Um, they're not just throwing darts at a dartboard hoping to land an investor, or chasing after random investors, you know, uh, uh, or every day or on a weekly basis. They have a system in place to attract capital to them. They have a system in place to consistently nurture their investor base. So those are the sponsors that consistently raise capital, are the ones that have thought about capital raising 6 months or 12 months out before they even found a deal, before they even started doing a project. They've thought about capital raising way before, and they've treated capital raising like a full-time job, which it actually is. It is a full-time job, to talk to investors, to get them comfortable in the deal, to build trust, to build credibility. So the most successful sponsors, right? And I'm talking from experience because I raise capital as well as a fund manager. It's having the right systems in place, and it's having the right processes in place, and it's treating capital raising like a full-time job, and a full-time position that either you've dedicated yourself to, as along with doing all the other things you have to do as a sponsor, or that you have someone on your team handling for you.
Beautiful. So, with your experience, can you share with us what does it take to build those real relationships with investors before you even have a deal to present to them?
Yeah, investors love a great story. I think that's what it really comes down to is what's your story. Um,
Mm,
where sponsors get this wrong is they think that investors care about the deal that they're going to be doing, or the expected returns, or the the project itself, the location, the asset class. Yes, these are all things investors definitely care about, but the more important thing that they care about is who is the sponsor? What's their story? What's their background? Who's on their team? Who's backing them up, right? Who's the law firm that's behind them? Who's the attorney that's representing them that is backing their deal, right? These are the things you're gonna look for. They're gonna look for these things, and they're gonna create this persona in their head about how trustworthy and credible is this sponsor. So everything that the sponsor does goes back to credibility and trust. That is how you build relationships with investors, right? You build it by establishing credibility and trust. And that starts with a great story, that starts with having a great team, and that starts with having all of your ducks in order, because all of these things are what investors will look for.
so, a little bit more than a Google search and a LinkedIn profile.
Much more than that. I mean, that is just the 1% of what you need, I think. Because yes, they are gonna Google you, they are gonna look you up on LinkedIn, they're gonna consume your content. They're gonna potentially do background checks on you. That's what I recommend a lot of my clients do. A lot of I do that when I invest with people. I recommend my clients do that when they invest with me on the fund side. Um, do a background check on me. Make sure you check the prior deals we've done. Um, and so I think all of those things are, yeah, super important. Having a great website, having a professional pitch deck, having a professional Excel model built out for your project. Um, just all of those things are so critical. And I know they have nothing to do with the actual investment itself, but it all helps build investor credibility and trust, because I've seen some of the worst deals get funded, and I've seen some of the best deals get no attention because all of those other pieces were missing.
Well, what information or conversations really help investors move from interest to seriously considering a deal?
Yeah, I mean, I think it goes back to the trust and credibility. So these days there's like a saying that it takes 7 touch points with somebody to get them to a place where they're comfortable with working with you and that they trust working with you. So I guess as your job as a sponsor is to um is exactly that, is to establish as many trust touch points with somebody as possible, right? And those touch points don't necessarily have to be phone calls and emails, right? It's a touch point is them seeing your LinkedIn profile, them looking at your website, them reviewing your pitch deck. Everything is a touch point. And at every touch point, you're establishing more credibility along the way. That's how investors go from having an interest to seriously considering a deal, is you're nurturing them through each and every touch point to build trust and credibility along the way. Where you lose an investor interest is when one of those touch points doesn't line up with what you've said, you're going to be doing, or something that doesn't build credibility, or instead something that actually reduces trust and credibility, right? And so that's why it's important to check all those boxes that we mentioned. We're talking about the prior question that you asked, is having all those things lined up, because that's what's going to help investors move from just I'm interested in this deal to I want to invest with you, because I trust that you're going to be a good steward of my money.
In addition to doing a lot of deals, you've also seen a lot of deals and sponsors. Can you share an example of a situation where a deal looked strong on paper, but investors hesitated or actually walked away, and why?
Yeah, I've seen this happen many times. And like I said, investors judge you based on who you work with and who's backing you as a sponsor. And the number one thing I see is sponsors that quote unquote DIY their offering. Um, that is the biggest red flag. I mean, today you can have everything lined up and still not get an investor because of how competitive the market is. So imagine how difficult it would be to get an investor if you're DIYing everything, right? Because an investor is going to look at you and say, if you're not spending money to do everything the right way, why would I give you money to invest it if you can't even spend money to set everything up properly, right? Like you haven't even done the basics, right? Um, w- why would I trust you with my money? So that's what I see happen all the time is clients cut costs on creating institutional quality pitch decks. Clients cut costs on legal services and hiring the right law firm to show the credibility, to show that they've structured everything the right way. So it's all of those things, right? Setting up a really poor website, having no presence on social media. Um, these are the reasons why investors walk away from a deal, right? Even if they like the deal and it was everything checked out on paper with the actual investment itself. Again, the investment is not being made into the deal. The investment is the sponsor. You are the investment. The deal is not the investment. And so that's the mindset shift that you have to take as a sponsor, is all of these things matter. And if one of those things are even slightly not there, you're going to lose an investor. You're going to lose a potential investor. Even if everything is perfect, you still might lose a potential investor because it's just so competitive out there to get investors. They have a lot of opportunities. So the least you can do is have all your ducks in order and be presenting yourself as an institutional sponsor. That's what's going to help the most.
So over time, you mentioned, I mean, things come up, people get busy, people get drawn away. And so, how important is communication and transparency in terms of keeping those investors close to you?
Oh, it's the number one thing. I'm invested in a lot of projects, and I can tell you that the sponsors that I invest with, the ones that I'll be investing with in the future, are the ones that keep me apprised of what's going on in the deal every single month. Right? I think at a minimum, uh, a monthly touch base with your investors is necessary in this market. Um, and the way to do that, again, is setting up the right systems in place to make sure that you are consistently communicating with your investors. Um, right, the right systems, the right setup. It'll ping you. It'll notify you, right, that hey, you haven't talked to this investor in X amount of weeks. Maybe you should
Right.
reach out to them and ask them if they have any questions about, what's going on. Make sure you reach out and give them an update on the project itself. So I think a monthly cadence is a minimum these days to give to your investors. But there's sponsors out there that are doing it on a bi-weekly basis. I think it's very difficult, but I applaud them because that is going to turn one investor into 10, right? Your next best investor doesn't have to come from you going out to the market to try solicit, other investors. Your next 9 investors could literally come from that one investor you have that speaks great things about you.
Absolutely. Well, as we wrap up here, and just briefly, where do sponsors most often misread what investors actually care about?
Yeah, this goes back to I think everything we talked about in this episode, which is sponsors think that the deal is what they're selling when in fact it's
Mhm.
themselves. And until they don't get that right, it doesn't matter how great the deal is. So that's the biggest misread there is, right? It's ignoring all the other things aside from having, again, a great deal. Which again, in this industry, yes, you need to have a great deal, but that's just table stakes. Everybody has a great deal. Otherwise, they wouldn't be going to the market to solicit their deal. But what's the story behind that deal? What's the story behind the sponsor? And again, how credible and how trustworthy are they? That's the key part about it all.
Well, thank you. That is it for today's episode of the Capital Stack Show, Real Estate Syndications and Funds. Raising capital isn't just about presenting a deal, it is about building the kind of trust and credibility that makes investors confident in moving forward. For more information or to connect with Shams, visit www.cre.law. Thanks for listening, and remember to like, subscribe to the show, and leave a review if you found this episode helpful. I sure did. Thank you, Shams.
Thanks so much, Leanne.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.